Welcome to this explainer. Today, we're going to take some seriously dense financial analysis concepts and transform them into an unforgettable exam-crushing study guide. Look, if you're gearing up for your management or strategic business exams, you already know the drill. Bridging that gap between theoretical numbers and real-world business decisions is literally the key to passing. So we're going to break down the whole shebang, from investment appraisals right through to the balanced scorecard. And we'll be using clear, super memorable examples that examiners absolutely love to test. Okay, let's dive right in. Here's a quick look at our agenda. We've got 1, making the investment decision, 2, managing risk and uncertainty, 3, financial performance and ratios, 4, non-financial performance indicators, and finally, 5, the balanced scorecard approach. Now, this mind map brilliantly illustrates our entire syllabus roadmap. It's here to ground us visually so you know exactly how all these seemingly disparate exam topics actually connect. You can see how we start right at the top with a core decision, branch out into investment, risk, and tax implications, and then flow smoothly down into performance evaluation. Honestly, whenever you feel a bit lost in the weeds during your prep, just picture this exact progression. It's a lifesaver. Starting with Section 1, making the investment decision. To invest or not to invest? We begin our business story at the inception phase. This is that critical moment where leaders have to commit massive amounts of resources to projects that are, frankly, incredibly difficult and expensive to abandon once they're greenlit. When you're appraising these projects, you've got to know these 4 primary methods cold: accounting rate of return, payback period, net present value, and internal rate of return. Now, what's absolutely crucial to remember here for your exam is that net present value, or NPV, is theoretically the best method. Why? Because it meticulously accounts for the time value of money, factoring in both the risk and the diminishing value of future cash flows. But wait, don't write off the other methods entirely. Keep this crucial exam advice in the back of your mind. Let's say you've got a CEO who remarks that calculating the payback period is a total waste of time because NPV is superior. Well, they're missing a pretty big strategic nuance. Payback is highly valuable when directors are uncertain about long-term timeframes and just want to make sure they get their initial cash back quickly. It's an incredible tool for a fast initial liquidity check. Moving on to Section 2, managing risk and uncertainty, expecting the unexpected. So, after deciding to invest, a smart business has to immediately start strategizing on how to mitigate things going wrong. Let's be real, forecasts are just estimates, and the real world rarely follows a spreadsheet perfectly. Examiners love testing this exact distinction. Risk is kind of like a card game. You know the possible outcomes, and you can actually calculate the mathematical odds. Uncertainty, on the other hand, is a whole different beast. The outcomes and probabilities are completely unknown, and that uncertainty drastically increases the further into the future your project goes. To make this really sticky for your exam memory, think of the Big Mart supermarket case study from the syllabus. Big Mart is expanding into a newly opened mixed economy country. These variables we're looking at represent what we call exogenous variables, basically factors determined entirely externally. Changes in consumer tastes, sudden tax hikes, or a shift in the population's disposable income. These are perfect examples of uncertainty that can entirely derail a perfectly calculated NPV. If you want to show real commercial acumen in your exam, you need to identify these external threats. All right, Section 3, financial performance and ratios, the numbers game. Okay, so we've made the investment, we've navigated the external risks, and the project is up and running. Now we have to measure the financial aftermath using those ratios that investors and analysts completely obsess over. But before we calculate anything, you need to pay very close attention to this terminology shift. For anyone taking their exam from September 2025 onwards, you absolutely must adopt these updated IFRS 18 financial statement terms. Profit before tax becomes profit before income taxes, and what used to call distribution costs are now selling expenses. Make sure you use the right language or you risk losing some incredibly easy professional marks. Now let's see this performance in action. Consider the well-heeled children's shoe shop example. On paper, their revenue climbed an impressive 20% to hit $240,000. Sounds great, right? But if you actually analyze their operating profit, it dropped from the previous year. Why? Because even though sales went up, their rent and staff costs surged significantly. This just proves that top-line revenue growth doesn't always equal financial success. You always have to look at the profit margins. And that leads us to a pretty fascinating question. Profits might be up this year, sure. But what if customer complaints are simultaneously skyrocketing? This brings us to a massive pivot point in our strategic decision life cycle. Because here's the dirty little secret. Financial ratios can easily be manipulated through accounting policies. And, more importantly, they are inherently backward-looking. They often completely ignore the actual, real-world drivers of long-term business success. Which brings us to Section 4, Non-Financial Performance Indicators Beyond the Balance Sheet. Ever since the 1980s, progressive companies realized that focusing solely on short-term financial key performance indicators, like relentless cost reductions, was actually destroying staff morale and product quality. This big realization led to the rise of tracking non-financial metrics. Just look at this breakdown of Ben's Grub Co., a takeaway food business. Financially, they look great. They sold 8,000 more meals in year 2, but their non-financials were screaming a massive warning. Independent quality ratings dropped, and customer complaints surged by a whopping 52%. If management only looked at the financial sales volume, they'd be popping champagne. But by looking at these non-financial indicators, they realize they are on the very brink of a massive customer exodus. Now, here is another massive exam trap you must avoid: confusing CSFs and KPIs. A critical success factor, or CSF, is a broad area where things absolutely must go right. For instance, excellent customer service. A key performance indicator, or KPI, is the exact specific number you use to measure it, like the percentage of orders delivered in under 30 minutes. Think of it this way. One is the goal, the other is the ruler you measure it with. Never, ever mix them up on test day. Finally, Section 5, the balanced scorecard approach, tying it all together. So, how do we combine all of this? How on earth do we balance backward-looking financials with forward-looking non-financials without just drowning in data? Well, to resolve the confusion of having too many conflicting indicators, Kaplan and Norton created the ultimate integrated performance tool. Instead of just looking at financials, we evaluate performance from 4 distinct perspectives: financial, customer, internal business processes, and learning and growth. See how they all orbit and feed directly into that central vision and strategy? It's simple. If a metric doesn't align with the core strategy in the middle, it shouldn't even be on the scorecard. A really crucial part of Kaplan and Norton's philosophy is understanding the cause and effect relationship between these perspectives. They categorize metrics into leading and lagging indicators. A leading indicator measures a cause, like, say, spending money on staff training. A lagging indicator measures the effect that happens later, like historical profitability. So, improving the leading indicator eventually pushes the lagging indicator in the exact right direction. However, and this is a big however, your exams love to test your critical thinking. You can't just praise these models blindly. You need to critique them. Always remember to cite these disadvantages. Implementing a balanced scorecard isn't some magic wand. It requires tough cultural changes and really extensive training. Furthermore, while it's fantastic for owners and customers, it shockingly ignores the fundamental needs of other vital stakeholders, like the baseline employees or the local community. I want to leave you with this final, somewhat provocative thought. If you had to abandon a mathematically profitable project because it ended up severely damaging your brand's reputation, which performance metric warned you first? Was it a lagging financial ratio or a leading non-financial indicator? Think about that as you continue your exam prep. Successfully navigating strategic business decisions means looking far beyond the balance sheet to spot the real drivers of long-term business survival. Good luck with your studies, keep these clear examples in mind, and you are absolutely going to crush your exams.